I request all of you to write down answer along with me. Method number one of decision making, whole project point of view. Full stop. Friends, the term whole project point of view stands for you make the calculation of NPV for both of them separately. So write down answer. Option number one, continue with existing machinery. I want you to write in the chat box that say if at all we continue with existing machinery, then in step number one, what would be the investment? Dear students, we understand if at all we continue with existing machinery, then we don't have to make any investment because the existing machinery has already been purchased before 2 years. Basically, friends, we have to understand that say for existing machinery, year 0, year 1, year 2, year 3, year 4, year 5, year 6. We are standing at this point of time and we are taking decision. So if at all we continue with existing machinery, we don't have to make any investment. We understand that say for existing machinery, this is year 0, the point at which we take the decision. This is end of year 1, end of year 2, end of year 3, end of year 4. That is the way we are required to make the calculation of answer. Write an answer. No investment is supposed to be made, comma, if company continues with existing machinery. Okay. So step number one, investment. In that, no investment. Next is step number two. In that, depreciation. Again, I request you to write in the chat box that if at all we continue with existing machinery, what would be the depreciation that we will claim? So depreciation, in that friends, we will have working of the answer in this way. Column number one is year, column number two is WDV, and column number three is depreciation. Year one, year two. We understand that say we had purchased the existing machinery say before 2 years for 6 lakhs. Rate of depreciation is provided to us as 20%. So 1,20,000, then it is 4,80,000. Again 20% of that is 96,000. So this is what say we understand is the time period which has been expired so far, 3, 4, 5, 6. However, for our understanding, this will be considered from end of year 1 to end of year 4. It means that say if at all we continue with existing machinery, this is the amount of the depreciation that we can claim in future. Accordingly, we are required to calculate the answer. So what will happen friends over here, 4,80,000 minus 96,000. That comes to 3,84,000 into 20 percentage. So it is 76,800 deducted from 3,84,000. So 307,200 into 20%, 61440 deducted from 307,200, 2,45,760 again into 20 percentage. So 49152, 245,760. So 1,96,608 into again 20%. So 39321.6. So dear students, step number 2, depreciation. In that basically we understand it is end of year 1 to end of year 4. And this is what we understand. First year end, second year end, third year end and fourth year end. This is part of the depreciation that we will claim in future. Please write down answer. Step number 3, terminal cash flow. Please write in the chat box that according to you what would be the terminal cash flow. Dear students, we have been provided that say in the existing machinery we have invested 1 lakh rupee in working capital. So if at all we continue with existing machinery, then in that case year 4 end, fine, year 4 end we will have working capital recovery an amount of rupees 1 lakh. There are a number of other assets in the block, so there is no question of capital loss or gain on sale of the machinery. So step number 4, that is terminal cash. So step number 3, terminal cash flow is 1 lakh, that is working capital recovery. Step number 4, recurring cash flow. Friends, in recurring cash flow again we will prepare working notes like this. Working note number 1, calculation of profit before depreciation after taxation. I'll prepare a working note like this. Because friends, again what will happen, yearly depreciation is going to be different and the remaining cash flows are going to be same. That is the reason. We'll make the calculation of the recurring cash flow say from the given information. In that, first of all, profit before depreciation after taxation, and then we'll consider the depreciation. Profit before depreciation and taxation. So friends, over here the information is provided to us with respect to the number of working days in a year. Listen me friends, it is 300. It has been given to us that say we are working for 6 hours a day. So 300 into 6, that comes to 1800 number of hours for which we are working. Then it has been given that the output per hour in terms of units is 20. That comes to 36,000 number of units. Then information is given that the sales value is rupees 10. That comes to 3,60,000. That is the way we are required to make the calculation of the sales revenue. So we'll get the sales revenue like this. Then we have been provided with the information, material cost is given on per unit term, then labor cost is given on per hour term. So like that, so the fixed cost is provided to us, that is an absolute term. So we are required to take into account all these things in the calculation. So I request all of you to write an answer. Now working note number 1, profit before depreciation and taxation. In that I'm writing sales. Working for 300 days, working daily for 6 hours. That comes to 1800 number of hours, multiplying with the output is provided to us. Output is 20, so it is 1800 hours into 20. That comes to 36,000 number of units. And selling price is provided to us as 10. That comes to 3,60,000. Next, we have been provided with the direct material cost. In that it is 36,000 number of units into 2. That comes to 72,000. Then direct labor. In that case, it is 20 rupees per hour. So 1800 hours into 20. That comes to 3,60,000. Yeah, sorry, 36,000. It comes to an amount of 36,000. Next is provided to us as fixed overhead. It is an amount of rupees 1 lakh. So this is profit before depreciation and taxation from end of year 1 to end of year 4. So in that case, it is 3,60,000 minus 72,000 minus 36,000 minus 1 lakh. So that comes to 1,52,000. That is profit before depreciation and taxation. I want you to tell me what is the cash flow after taxes for the first year. Calculation of CF18, cash flow after taxes. Column number 1 is particulars. Opposite to that, first year, second year, third year, and fourth year. Please write in the chat box what would be CF80 for the first year. So friends, over here, we can start with profit before depreciation and taxation. It is 1,52,000. From that, we can deduct the depreciation. See, the amount of depreciation for year 1 is 76,800. So we get profit before taxes. It is 75,200. Income tax rate is given to us in the question as 30%. So profit after taxes is 70%. It is 52640. Okay. Or otherwise you can write the tax and then you can mention the earning after taxes. That is also the way you can do it. 75,200 into 0.3, 22,560. And profit after taxes is 52640. Now basically the depreciation is a non-cash item. Amount of depreciation is 76800. So CF80 would be 129440. And so on we can compute for the remaining years. For the second year, similar working will be shown. 1,52,000 again 1,52,000, again 1,52,000. Amount of depreciation will keep on decreasing. 61440. Next it is 49152. And for the last year it is 39321.6. So profit before tax is 152 minus 61440. So 90560 into 0.3, 27168. 90560 minus 27168. 63392 plus depreciation 61440. So it is 1,24,832. That is the second year CFAT. Similarly, for the third year and fourth year, it will be calculated. One lakh 52,000 minus 49152. So 102,848 into 0.3, 30854.4. 102,848 minus 30854.4. That is 71,993.6. 49152. 1,21,000.60. 152 minus 39321.6. So it is 1,12,678.4. So 33,803.52. So it is 78874.88 plus 39321.60. It comes to 1,18,196.48. This is the way the cash flow after taxes can be calculated. Step number 5, calculation of NPV. First year, second year, third year, fourth year. Cash flows. 1, 2, 3. In the fourth year, apart from this, we have to add the terminal cash flow. Whatever the cash flows that we have, that will be discounted at the given cost of capital. That is over here 10%. We have been provided its factors also in the question. It will be discounted in present value term. There is no investment, dear students. Why? Because it is an existing machinery. So whatever is the present value of the cash inflow itself is NPV. I request you to write down NPV answer. So first year end, it is 129,440, 124,832, 121, 145.6, 1,18,196.48 plus 1 lakh. So 218,196.48. Based on this, we get present value of the cash inflow. Investment is 0. So whatever is the present value of the cash inflow itself is NPV. So over here 129,440 into 0.909. So it is 1,17,616.96. 124,832 into 0.826. 1,03,111 123. 1,21,145.6 into 0.751. 90980.35. 218,196.48 into 0.683. 1,49,028.20. So 117,660.96 plus 1,03,111.23. 90980.35. 149,028.20. So it is 460,780.74. Investment is 0, and this is the NPV for our first option, that if at all we continue with the existing machinery. So this is a question of the replacement. In that, option number 1 is continue with the existing machinery. In that, so the remaining life of the existing machinery is 4 years. Step number 1, investment. In that, no investment because it is already in operation. Step number 2, depreciation for the remaining 4 years. First and second year, which has already been expired, is of no use to us. Terminal cash flow is consisting of the working capital recovery. There is no scrap value of the machinery. Recurring cash flow, in that, profit before depreciation and taxation. And then we make the computation of the CFAT. From the profit before depreciation and taxation, depreciation is deducted. PBT, tax is deducted. PAT, depreciation is added, and CFAT. Year 1 to year 5, that is 4 cash flows are discounted in present value term, and based on that NPV is calculated.